Hello traders, welcome to Alpha over Beta webinar. We are going to talk about how to manage your risk with each and every trade that you make. Managing the risk is the most important aspect of each and every trade that you will have, and this is why it's very important to understand many aspects of the trade before you actually perform the order and send it to the broker. So in this specific video, we are going to discuss how to limit your loss before you issue the trade. What's the maximum loss as you set it for each and every order that you issue to the broker? How do you do that, and how do you set it before you send the order to the broker? So in order to know the maximum risk before you issue the order, this video is specific answer to that question. So so what's the question we want to answer today? The question is, how do we know what is the maximum risk before we make the actual trade? Say we actually perform the analysis and we check all the stocks and we know what we rank higher and what stocks we would like to get. In case we do that, we have the analysis results in front of us, and we are going to automatically issue that list of picked stocks that we have picked to the trader. Now, it's not a robotic action as you just copy and paste it from the list. Every specialist or trader with a bit of experience know that it actually involves a bit more than that, and this is what we're going to discuss right now. Okay, so we invest a portion of our portfolio without the full knowledge of the impact of this trade on our total bottom line, and this is exactly what we would like to remedy. We would like to correct that, and we would like you to know what is the impact on the total bottom line. All right, so the answer to the question, how do we know, is that we use a formula, which I will show you in a minute. And that formula would control the invested amount and the maximum risk. Okay, so three basic questions. What is the entry price of the order that you're about to issue? Where is the stop loss? Okay, this entails that every order that you send to the broker is actually two orders. One is to buy or sell, and the other one is the stop loss. Okay, most modern brokers enable you to do that with one order. You issue the entry trigger and you attach a stop loss level. All right, and the third question is, what is the dollar amount loss that you are willing or planning for each on every trade? All right, so let's take a look at the formula. All right, so the formula, the basic aspect of the formula is it determines the size of the order that you're about to issue. All right, how does it do that? You first have to establish what is the maximum dollar loss that you're going to that you are willing or planning to have on the entire order. Okay, on this particular order, what is the dollar loss that you're planning, or what is the, according to your risk profile, what is the maximum loss you're willing or planning to have in this specific order? Okay, this is the limit. If you say that you're willing to lose $100, this is exactly what you're going to lose in case that the trade goes against you. Okay, now if you have a trading strategy, this is not the common event. All right, it doesn't happen often, but when it does, you should limit the loss with the aid of a stop loss and the formula that we are about to see. Okay, so you're trading with a strategy. If you're trading with a strategy that is back tested and you know what are the results, you know what the drawdown is, you have no surprises there, you just issue and plan the maximum loss and you enter that number in here. All right, so this is the maximum loss. the second thing that we have to calculate is the distance between the entry price and the stop loss, where we have it, right? So this is just an example. I would like to show you the base of this example in a minute, but let's just establish the baseline. The size is calculated as the maximum dollar loss and divided by the distance between the entry and the stop loss. Now let's jump to the example and we will see exactly what we're talking about. So in this example, this is today's market. This is the SPY ETF. It represents the S&P 500 divided by 10. The level at the moment is 321. Sorry. And so let's say that the entry price is 325. This means that I would like to enter the market in case the market goes above 325. All right. But if it goes, hence this is a long position. So if the market goes to above 325, I'm in a position. Now, if I'm in a position, I would have to establish where the stop loss is because I want to limit the loss. This is the basis, the foundation of this calculation. I want to limit the loss. So how do I limit the loss? Say I would like to stop loss. I would like to exit, close the entire position at 315. All right. So this means that if I enter the market at 325, and close the position when the position went against me at 315, that means that I have lost $10 per each and every share that I bought, right? Because if I enter 325 and exit 315, that would represent a loss of $10 per each share that I bought. If I bought 2 shares, that would be $20. If I bought 4 shares, that would be $40, right? So this is how you limit the loss. You put a stop loss and you know what is the maximum loss you're going to lose per one single share. Sorry. So if you know what's the maximum loss you're going to lose for one single share, and you also know what's the maximum loss you're willing to take for the entire position, all you have to do is divide the maximum loss that you have set before you issue the order, the maximum loss for the entire position, divide that for the loss for one share, and you get the number of shares that you have to invest when you send the order to the broker. Okay, you take the entire loss for the entire order and you divide it by the loss of one share. And this is how you get the size, the number of shares that you are willing or that you should buy in order to limit that exact loss that you have planned. All right. So let's get back to the example. In our example, we have set a maximum dollar amount loss of $100. How did we come out? How did we come up with this this amount? This is according to my personal risk profile. This is the maximum amount I'm willing to lose. Now, if I have a neighbor who is more risk prone, he would put $200 or $300 in here. Now, if I have another trader trading right next to me and he is risk averse, he would put a lower number in here, like $50 or $20, okay? So the number in here is just your risk profile. How much are you willing to lose, right? And then you go to the lower part of our calculation and you put the distance between the entry price, 325, as we saw it in our example, and the stop loss, which stands at 315, and that's $10. $100 divided by $10 is 10. So the size of the order that we are going to send to the broker is 10 units of that SPY ETF that we are going to buy. All right, and how big is the investment? 10 shares at the price of 321. Sorry, 325. If you remember, 325 is the entry price. So $3,250 would be the amount invested. Okay. Now that you know the basics and the simple math behind it, we have prepared a calculator in Alpha over Beta's website. What you should do is go to Alpha over Beta. In Alpha over Beta, we have our services. We have a number of services, as you can see here in the list. We have the strategy development service and the real-time trading alerts and many more. And we will add as we develop them. And we have the risk calculator, which is the risk calculator that hides the formula that we have just seen in our presentation. So going down to the risk calculator, you put the current price of the market. This has nothing to do with the calculation, it's just for informational purposes only. So the market stands today at 325. So it doesn't matter. Let's put 325. All right, now sorry, it's 320, right? As we saw in the previous chart. The entry, as we said, is 325. This is exactly the number that we would like to enter the market as. It's 1.56% above current price. The profit to loss ratio is something that we should discuss really. The profit to loss ratio establishes a ratio between the profit that you are about to profit from this transaction and the loss that you're willing to take, right? Now, say statistically that you have 1,000 trades, 10,000 trades, maybe 100,000 trades. We hope that you trade with a strategy that wins more than you loses, all right? That wins more than you lose. How do you win more than you lose? You make sure that your strategy has a profit to loss ratio that's above 1. This means that for every dollar you lose, you profit above that. You profit more than $1, all right? You have a profit of more than $1. So if you lose $1, in the next trade, you will make or gain more than $1. Now, if you put a number of 2 in here, this means that your strategy has a profit to loss ratio of $2. This means that for every dollar that you will lose or about to lose, in the next trade and the next one after that, you will make more than $2, all right? So you have to know that number just by looking and testing and back testing and perfecting and monitoring your strategy. If you don't know that and you're trading manually and you have no history, a number between 1.5 and 3 would be a nice range. So let's put the number 2 in here and make sure that we make $2 for every dollar that we lose. The maximum absolute loss, if you remember, we set to 100. That's the maximum amount that we were willing to lose. The stop loss, sorry about that. The stop loss was 315. So let's put 315 and we get all the numbers that the formula have calculated. The stop loss would represent us a loss of about $3. The stop loss in dollar terms would be $100. Of course it would, right? It's what we planned. The take profit level would be at 345. At 345, we would be closing the position with a 2-to-1 ratio. All right, we would take the profit. The take profit distance from the entry price would be a gain of 6.15%, which would be in dollar terms $200. The size of the calculation would be 10. If you remember, that's what we saw in the presentation. And the amount invested is 3,250. All right. So this concludes this video that explains how you control your risk and how do you know what's the maximum risk you're about to have in each and every trade. It sets a stop loss. It actually stops your losses before they can grow and affect the bottom line of your portfolio. You know exactly how much you're going to lose in each and every trade, and that's by setting the size. That's the result of the formula when you issue the broker order. Okay, so this let's go back to the formula. This is the formula that you use. You saw the calculator on Alpha over Beta website. This is the calculator that we have prepared for you, and this is the example that we saw. 325 entry, 315 stop loss. A crucial part of every order, do not trade without a stop loss, and the -10, which translated into 10 shares of the entire order. So thank you very much for listening to this podcast, to this webinar. We hope that you have enjoyed it. If you have any comments or reviews, we would love to hear them. Please send your comments and reviews to info at alphaoverbeta.net. Visit our website for more information, comments, reviews, and whatnot. Have a safe trading week. Goodbye.